Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor. Today, we have some interesting news. We're going to be covering a move that I just made in my stock market portfolio. I did just sell out of Dominion Energy, and I bought into Duke Energy. I'm going to be going over why I did this, my reasons behind this, and I want to show you some important piece of information that just happened with Dominion Energy that made me want to sell it. Now, I'm going to go over the information that I was reading about the deal, and I wanted to get your guys' opinion on it. I think that, in my opinion, for Dominion Energy, that this is absolutely horrible. We'll go over the whole story there. Maybe if I'm missing something, go ahead and comment down below what you think about the deal and whether or not Warren Buffett or Dominion Energy got the best side of the deal. But in this video, we will be going over the deal between Dominion Energy and Warren Buffett. We will be going over some new news with Realty Income with turning to the debt markets to raise more capital. And then we'll also be going over pending home sales and how they had an historic rebound. So overall, guys, if you aren't familiar with me and you're not used to my channel, I do track my annual dividend income, my monthly dividend income, and my portfolio value because I am a dividend investor. I currently own 31 different stocks in my portfolio using the brokerage M1 Finance, and all of these stocks, all 31 of them, are dividend-paying companies, and most of them are very old blue-chip companies that you all know and love. And one of the stocks that I owned was Dominion Energy, and I just sold out of it. But if you want to stay till the end of the video, I will be giving an update on my entire portfolio, all 31 of these stocks, and then giving my opinion on all of them. So if you want to use M1 Finance, if you're interested in using this brokerage, I will be showing it throughout the video and all of my other videos. Go back to there. In the description of my video, there is this link. Go ahead and use this to sign up through M1 Finance. There are a lot of other links in that description as well. So if you're interested in using any of those things down below, go ahead and check that out. There's lots of other information down there. So go ahead and check that out. But let's go ahead and get started with this story between Warren Buffett and Dominion Energy. So for Berkshire Hathaway, that is Warren Buffett's company. Berkshire Hathaway makes tons of different acquisitions through extremely large corporations like Dominion Energy. They own shares of Apple, they own shares of Bank of America, they own shares of Wells Fargo, Coca-Cola, and they own outright many different businesses, including candy businesses, Geico and insurance, railroad companies. There's all different types of different things that Berkshire Hathaway owns outright as well, and they look to make large acquisitions. So when Berkshire Hathaway does a deal, they're not looking at doing a $10 million deal, a $100 million deal. They're looking at doing a multi-billion dollar deal with all different types of companies. Now, Berkshire Hathaway does have an energy sector where it's Berkshire Hathaway Energy, and that looks to make deals through natural gas, electricity, things like that. So on July 5th, news broke that the company would be acquiring substantially all of the gas transmission and storage assets from the utility giant Dominion Energy, in a deal valued at $9.7 billion in all. Though this uses up only a small piece of cash on Berkshire's books, because the move is more about the absorption of debt than it is about spending cash, it's a nice add-on acquisition for Berkshire and a fine way for Dominion to continue restructuring its business. In all, the maneuver looks like a win for both parties, but the ones likely least excited about the transaction in all will be Dominion's own shareholders because of the implications it will have on the firm's cash payouts to them. So one thing I want to stop at right there. So usually, if you know anything about Berkshire Hathaway and Warren Buffett, 99% of the time when he makes a deal with anybody, it doesn't matter the sector, doesn't matter the company, doesn't matter the type of deal, Warren Buffett has such a large pile of cash, 137.26 billion to be exact, one of the largest stockpiles of cash in the world. When he makes a deal, he always gets the better end of the deal, 99% of the time. What he does is that he stockpiles this cash when recession hits, and then when times get tough and companies are struggling to scrounge up cash, he'll get incredible deals. During the 2009 Great Recession, he picked up some steals on some banks like Bank of America that were incredible. So before we go into that and the details of the deal, just keep that in mind. A look at the deal. The transaction between Berkshire and Dominion is quite simple at face value. According to the press release issued about the deal, Berkshire will pay to Dominion the sum of about $4 billion in cash. In addition, it will assume $5.7 billion worth of debt from the company. In exchange, Dominion will hand over nearly all the assets associated with its gas transmission and storage operations. The only assets under these operations that will be retained are Dominion's 50% non-operating and unlevered interest in Cove Point, as well as its investments in RNG or renewable natural gas. Now, so what it says right here, Berkshire will be giving about $4 billion in cash, and then Berkshire will be assuming it's $5.7 billion worth of debt. It sounds good on the surface until you keep on reading further. The reduction in leverage seen from this transaction is easy to see, but what about the cash? According to Dominion, it will allocate about $1 billion of the cash between transaction taxes and adjustments. This also includes $250 million that will go towards funding the firm's pension plan as a voluntary contribution. The remaining $3 billion, meanwhile, will be allocated towards share buybacks, likely occurring in late 2020 when the deal closes or occurring sometime in early 2021. So this paragraph of this entire article is the most important here. Where are the funds going? $1 billion of the deal will be going to transaction taxes and adjustments. You can't avoid that. That's okay. And then $250 million will go towards funding the firm's pension plan. Okay, that's fine. And then the last section right here, 3 of the 4 billion, 75% of the funds, the remaining 3 billion, meanwhile, will be allocated towards share buybacks. Now, my opinion on share buybacks, those of you that know me, I am a dividend investor. So anytime that a corporation wants to return money back to shareholders, I would always prefer that it's done in the form of dividends rather than the form of share buybacks. Another thing, when you're doing share buybacks, this is mainly focused on companies that are growing rapidly. They want to keep on upgrading their stock, like Apple, for example. Apple is a stock that is growing quite substantially. They have a huge market cap, and they want to return to shareholders that way because paying out dividends is not as smart of a way for them to return money to shareholders as it is doing share buybacks. That's part of the reason why the stock is exploding. Just like for, say, a Microsoft, for example, it's other trillion-dollar company that is thriving right now. It is going sky high. Both these are companies that I own. But with Dominion Energy, a lot of people that own this stock are owning it for the same reason I am. They want to own it for the dividends, and they want to own it for the compounding growth of the dividend over every single year. Now, $3 billion in share buybacks. What this says to me is a lot of times with CEOs and upper management, they have to hit certain price targets. I'm just going to make up a number, for example. So let's say that Dominion Energy has to be $80 a share by the end of the year for the company executives to hit a bunch of bonus levels, for them to hit millions of dollars worth of payouts. What they can do, we could either, we could grow the business, keep on trying to get it more and more profitable. Oh, but in this unshaky market, we could just go ahead and do share buybacks, try to get the share price up to $80 a share, and then just cash out on a big profit. This is not what I like to see. This is not what I like at all. What this story doesn't tell you is that their assets that they just sold away to Berkshire Hathaway were profitable. They were growing revenues. They were getting huge profits every single year. They were growing that dividend. If you see here over the last 5 years, the dividend was 65 cents a share. And then it bumped up to 70, 76, 84, 92, 94. And they were growing a dividend pretty fast for an old, large utility company. And now they're going to sell a huge part of their business, a giant chunk of it, to Warren Buffett so that way they can fund share buybacks. I don't like this. I don't want to see this, and I do not want to be a part of this. So let's go ahead and keep reading here. For Dominion, the picture is a little more complex. It's not just about the numbers for the business, it's also about a long-term strategy. In recent years, Dominion has undergone a flurry of M&A activity to become more focused on regulated utilities for its earnings. In 2019, for instance, about 70% of its operating earnings came from state-regulated utility operations. This deal will move that figure up between 85 and 90%, putting the business well on its way to being 100% pure play in the space in the not too distant future. Of this 85 to 90% figure, between 55 and 60% will come from its Dominion Energy Virginia business. This involves electricity distribution, transmission, and generation. The rest, as the image below illustrates, come from the miscellaneous operations spread across several states. So, what they are trying to do is they're trying to get away from natural gas and go strictly 100% pure play towards just basic electricity. Now, I understand that, and they have promised that to shareholders by 2050, but we're talking about 2050. We're talking about 30 years from now. And so what I like to think is, okay, so we have $4 billion in cash. We could either keep on funding this natural gas or sell it off, or we could just start moving the funds and then sell it off and then move the funds more towards utility-based things like electricity that's more cleaner, renewable energy. That's fine. So why not take the $4 billion or $3 billion, what's left of it, take the $3 billion and start buying operations that are more utility-based in areas like electricity that are renewable energy? Why not? No, we want to fund share buybacks. So overall, not only do I think that this is a little bit sketchy that the management is wanting to fund share buybacks, but regardless, if they're wanting to fund share buybacks, why not just invest more into the business and grow revenues, grow profits? The share price, in my opinion, will probably benefit more, not only for the shareholders, but also for the upper management, if they were just to grow revenues and profits rather than to fund share buybacks. By divesting of these assets, Dominion will be saying goodbye to valuable earnings, but it will attain significant progress in terms of its goal of becoming carbon and methane neutral by 2050. Back in 2005, the company was only 35% of its way to being carbon and methane emissions neutral. This sale will significantly accelerate that, placing the company on track to reach the 70% way of the target by 2035. It should be mentioned, though, that selling off these assets alone won't get it there. The company also plans to invest around $55 billion towards growth capex between 2020 and 2035. That will be more environmentally friendly than carbon-based options today. Example includes wind, solar, battery, and even nuclear relisting. So all these categories that I just gave, wind, solar, battery, and nuclear relisting, those are all different options that they could have invested in. They could invest in these now and then reap the profits years down the line, and the shareholders would love that. Now, here's what I also wanted to talk about. The last paragraph here, and then we'll finally get off the Dominion subject. It would be wrong to state that this move by Dominion won't leave some shareholders a little unhappy. That is because the sale will result in the company's operating earnings falling quite a bit. Instead of the $4.25 to $4.60, or the 443 midpoint in operating earnings, the company was guiding for 2020 it will now earn between 337 and 363 for a midpoint of 350. So right there you can see that the midpoint they were expecting on average about $4.43 of profit in earnings per share. Now they're only expecting 350. This difference won't disappear for the current year because of the timing of the sales completion, but it will move the difference into discontinued operations and will impact the firm in years to come. Now, what the company tried to do is try to do this little spin-off is that, instead of having 2 to 4% earnings growth per year in dividends, now what we're going to do, we're going to grow the dividend at about 6 to 7% a year. Well, why is that a benefit if you just cut our dividends by 33%? You can see here that it's going to reduce the dividend to $2.50 per unit per share essentially in 2020. Now, last year if we add this up, so let's see, last year it was paying 92 cents a share. So if we take 0.92 times that by 4, last year they paid $3.68 worth of dividends. Okay, if you want to divide 2.5 divided by 3.68 and then minus by 1, that means that they have a 32% reduction in the dividend being paid. So they can fund share buybacks. Who cares if the dividend is going to grow faster if you're just going to reduce my payout by almost a third? So overall, guys, this whole situation here with Dominion Energy, the deal that they dealt with Warren Buffett, I wish that they didn't do it. I'm trying to see the logical solution here and what their reasoning behind this deal would be. I understand that it did deleverage them a little bit. That's like the only positive I can see here. They are a little bit deleveraged, but a profitable, extremely profitable, government regulated utility company that gets profits year round. If you're selling off profitable assets, it's almost never a good deal unless you're just selling them for a lot more than it's worth and you can just reinvest that back into the business. And the fact here, the one thing that was the tipping point for me, if you probably can't tell already, the fact that they sold off their assets, I don't like it, whatever. They could have invested that in so many different areas. They could have invested back into their own company in the form of growing revenues, but no, they wanted to fund share buybacks. So overall, guys, let me know down in the comment section if you think I'm right about this, if you think I'm wrong about this. Maybe there's something I'm missing, but I already did sell my stake in Dominion Energy. It was only about 2% of my portfolio. I sold it for almost exactly of what I owned it for. If you see my activity tab here, where we go, afternoon trading. So I did own it for $74.30 a share. So I sold it for about a $1 a share price gain. It was a very small holding in my portfolio anyway, so it didn't matter. And I did receive one dividend payment for about the 3 months that I owned it. But bye-bye Dominion Energy and hello Duke Energy. So those of you that don't know, Duke Energy is extremely similar to that of Dominion. I thought about adding that over Dominion when I first started the portfolio about 3 months ago when I started the channel. But overall, guys, these companies are extremely similar, but Duke Energy has not made a horrible management decision like the Southern Company, the one that I own, which is my largest utility company in the portfolio. You can see right here. Southern Company, Duke Energy, and Dominion Energy have very similar performances. 24% over the last 5 years for Southern Company. For Dominion Energy, it's 22%, and then for Duke Energy, it is 12%. So overall, guys, pretty similar, and the dividend growth is pretty similar as well, and I think that Duke Energy will continue to replace that of Dominion Energy's dividend spot. So with Dominion Energy, to say that it would pay out $2.50 worth of dividends, let's go ahead and calculate my yield here. This is what you would get on a dividend basis. So you take $2.50, divide that by $74 a share, your yield is 3.37%. 3.3. If we take Duke, we go here, we click 5 years. The last dividend payout was 95 cents a share. We take 95 times that by 4, 3.8, divide that by 81.23, the share price. So with Dominion's Energy, you would get 3.3, but with Duke Energy, you'll get 4.6% yield, a 1.3% higher. Not to mention they have not made horrible management decisions just like Dominion Energy did. I think that Duke Energy will perform better in the long run after this deal that they just performed. But off the subject of Dominion Energy and Duke Energy, let's go ahead and jump into Realty Income, another one of my holdings. It is the second largest holding in my portfolio. You can see right here, we're up about 25% on it, and it is underweight my portfolio, so I'll probably be buying a couple more shares either today or tomorrow. So Realty Income files to offer more 3.25% notes due 2031, a further issuance to its $600 million note sold on May 8th of 2020. Plans to use proceeds to increase liquidity by repaying borrowings under its $3 billion revolving credit facility to fund potential investment opportunities and for general corporate purposes. As of July 1, 2020, Realty Income had $628.6 million of outstanding borrowings under its revolving credit facility, and as of July 1, the company had a total of $74 million in cash and cash equivalents and a $300 million term deposit maturing on July 24, 2020, so about 2 weeks from the time I'm filming this. Now, with Realty Income, this is something that I like to see. So Realty Income being as much as a financially stable company as it is, people believe in it, they have great credit ratings, they can offer debt at a measly 3.25%. Now if we go ahead and pull up Realty Income here and we go to their investor relations page, I brought this up many times before. With real estate, in the long run, it only goes up. As much as I hate to admit it, it is like the stock market, it only goes up in the long term. And now a lot of these people, a lot of their contracts are very high corporate areas with a lot of very nice buildings. You can see how the number of properties grows every year. You can see how their portfolio occupancy always floats around 98, 99%. It's incredible at what this company does from a real estate perspective. Now, 3.25%. If I were to guess just the gains in the value of the properties alone, the value of their assets from the properties that they own, that they rent these people out to, I'm sure would probably grow at least 3.25% between now and 2031 on an annual basis. Not to mention that they raised their rents at probably about a 3% rate. I think that this is an excellent move for Realty Income. Getting some cash now while times are tough, being able to fund those dividends, fund its operations, and then in the long term be able to pay off those cheap 3.25% notes will be no issue for Realty Income. You see some companies like Carnival Cruise Lines, for example. Carnival Cruise Lines had to issue some bonds, issue some debt, just like Realty Income is, except there's one main difference here. Realty Income doesn't have to pay this back for over a decade, but it's at a 3.25% rate. Meanwhile, Carnival Cruise Lines, do you want to know what they had to issue theirs at? It wasn't 3%, it was 13%. If Realty Income was issuing their notes at 13%, I would say, oh my God, this is horrible. But at a 3% rate, that is very conservative, and I love to see something like this coming from Realty Income, and I think that it's going to help them in the long run, so I absolutely love this move. But I'll just quickly go over this article. I won't get too deep here into this Market Watch report. Pending home sales stage a historic rebound in May, meaning the worst may have already come for the real estate market. After 2 consecutive months of decline, the index of pending home sales soared 44.3% in May as compared with April, the National Association of Realtors reported Monday. The monthly increase was the largest ever since the National Association of Realtors started the index in January of 2001. This has been a spectacular recovery for contract signings and goes to show the resiliency of American consumers and their evergreen desire for home ownership. Now, the reason why I wanted to just mention this article is because it's showing that pending home sales are at an all-time high. They are staging a huge recovery. Now, what's the best part of this? Realty Income, one of my largest holdings, my second largest holding. They're into real estate. So it doesn't matter if you're talking about residential or agriculture or whatever, when there's a demand in the real estate, all prices go up, whether you're talking about office buildings or whether you're talking about large corporations, big industrial factories, residential, whatever the case may be, this will just drive up real estate prices. And I think that this will benefit Realty Income in the long run as well. So overall, guys, that pretty much wraps it up with my portfolio. You can see my charts right here. As usual, it stayed the same. I will be updating that at the end of the month. But overall, guys, with my portfolio, on a time-weighted return, we are up 11.67%. And on a money-weighted return, we are up 17.06%. Total gains, 327.38 coming from total gains. $302.36 coming from market gain, 25 and 2 cents coming from earned dividends. And then you can see my biggest winners here, a lot of the same names, and then my biggest losers here. We are down on Duke Energy because we did just add it, but we're down to about 6 or 7 stocks out of the 31, and we are finally down one that is double digit store capital. I'll be buying more of that stock probably this afternoon once the market hits 2 o'clock for that trade window. But overall, guys, you made it all the way to the end. Go ahead and use this link down in the description if you see it right here. This link right here will get you $10 just for getting signed up through M1 Finance. So if you're interested in that, go check that out, and there's other links in the description as well. If you have any comments for me, go ahead and comment down below what you think about this Dominion Energy / Berkshire Hathaway deal. I think it is just horrible on Dominion Energy part, and just go ahead and let me know what you think about that deal down below, or any questions you might have for me about the stock market, my stocks, or just any questions about my personal life in general. So thank you guys for watching, and I will see you next time.